Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, our analysts share 3 dividend growth stocks for your radar. Russ Kinnell highlights funds with exceptional people ratings. Julie Buzil-Sharma explains why we raised Intuit's fair value estimate. Katie Reichart uncovers reasons for Oakmark's success. And Damian Conover shares key takeaways from pharma earnings. Let's get started. First, 3 dividend growth stocks for your radar.
Hi, I'm Susan Jabinski from Morningstar.com. There's a lot to like about stocks with growing dividends. Not only do dividend growth stocks pay out income on a regular basis, but they also tend to be highly profitable, financially healthy businesses. Today, we're taking a look at 3 stocks that were recently added to the Morningstar Dividend Growth Index, which consists of U.S. stocks with a history of consistently growing their dividends and a significant margin to continue to do so in the future.
So Gilead is a wide moat biotech we cover at Morningstar. It's trading at about a 20% discount to our $84 fair value estimate. It's best known for its dominant HIV franchise, as well as hepatitis C treatments and cancer therapies. I think investors right now are concerned about where sales growth is going to be coming from in the future, as well as its late-stage pipeline. If you look at our forecast, we've got very stable, growing HIV sales going forward through 2033. And this is really because of a new HIV drug they have, Biktarvy, that's just been launched and had a tremendous growth profile so far. We also think their pipeline, even though it is thinner than some other companies, it has very strong prospects for an arthritis drug that's going to be launching this year. So that's a multi-billion-dollar franchise. So overall, looking at free cash flows, Gilead's able to churn out about $8 billion a year in our forecast period. And I think that's going to be putting them in a really good position to pay strong dividends going forward and also make the acquisitions that they need to encourage a stronger growth profile. They've been paying a dividend since about 2015. Dividends have been increasing every year, most recently an 8% increase. And I think the size of those increases is going to be varying a little bit depending on how large their acquisitions are, but management looks very committed to increasing in the future.
Wide moat Intel has a strong track record of cash flow generation and is in solid financial shape. Although the firm is a net debt position of $16 billion, primarily stemming from large acquisitions such as Altera and Mobileye, we expect the firm to meet its financial obligations. Although the firm will face some pressure from AMD in the near term, we don't expect significant damage to Intel's cash flow prospects. We expect the firm's PC business to decline in the low single digits in the near term, mostly offset by strength in the cloud computing, artificial intelligence trends, as well as adjacencies such as Mobileye and the Internet of Things group. From a CapEx perspective, Intel has massive CapEx outlays for its manufacturing footprint, which we expect to average $16 billion over the next 5 years. From a dividend perspective, Intel has grown its dividend at an average of 7% over the last 5 years, and we expect to grow it at 5% in the coming 5 years, based on our expectations of mid-single-digit revenue and earnings growth.
Citigroup has a below-average dividend yield compared to the rest of our traditional U.S. banking coverage. Citigroup's dividend yield is roughly 2.6% compared to an average of 3.2% for the rest of our banking coverage. However, Citigroup is comparable to a few of its money center banking peers. JP Morgan, for example, is right around Citigroup's level. Bank of America is even slightly below. Either way, dividend yields aside, Citigroup has a dividend payout ratio of roughly 25%, and we think the bank can slowly ease its way up to roughly a 30% payout ratio. This combined with 5% to 10% EPS growth over the next several years should give the bank ample room to increase its dividend over time. You combine a gradually increasing dividend payout ratio with 5 to 10% EPS growth, and it's not unrealistic to assume that Citigroup could grow its dividend in the high single-digit to low double-digit range over the next several years. Concerning sustainability, with a payout ratio that low, we have no concerns about the sustainability of Citigroup's dividend. The bank could easily rein in share repurchases to absorb any hit to earnings. Also, with regards to valuation, shares look roughly fairly valued to us at this time.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit Morningstar.com/Alexa.
Now, Russ Kinnell highlights funds with exceptional people ratings.
Hi, I'm Christine Benz from Morningstar. A firm's people are one of the key attributes our analysts use when they rate a fund. Joining me to discuss the people grade, as well as some funds with top people ratings, is Morningstar's Russ Kinnell. He's Director of Manager Research. Russ, thank you so much for being here.
Happy to be here, Christine.
Russ, let's get into the analyst rating and talk about the people grade as part of the rating. What else figures into the analyst rating of a fund?
So we rate people, process, and parent. Those all factor in. And then we also do quantitative elements where we assess the return potential of a category, and we also then factor in all the share class fee level of a fund to come out with the analyst rating for each share class.
Okay, so that people prong in particular, or pillar, let's talk about how you and the analysts get your arms around what grade you give a fund on its people. You're looking at manager tenure, manager track record certainly, but what else?
Yeah, so one way to look at it is we're thinking about the competitive advantage. So obviously there are lots of experienced managers or lots of analyst teams with big numbers, but we're really looking for who are the best, who have abilities that just continue to add value over time. And so, of course, the manager's track record, especially if they have a very long track record, is very helpful. But also we look at it versus peers. Where do they stand out? Do they really bring something unique to bear? Because, of course, lots of funds have smart managers with lots of degrees,
right.
And we're really looking for those that truly stand out. And really, it's not just people, it's the analysts, the traders. How do all of those pieces come together for the people?
Okay, so let's talk about some funds that earn high people grades. You wrote about this in the most recent issue of Morningstar Fund Investor. I noticed a couple of Causeway funds cleared that hurdle. Both Causeway Global Value and Causeway International Value have high people grades. Let's talk about why you rate the firm highly, why you rate the funds highly from this standpoint.
Yeah, well, you start with two very experienced managers, and Sarah Ketterer and Harry Hartford. They're managers we've been covering probably since I started here 25 years ago, back when they were at Hotchkiss and Wiley. They started Causeway in 01, but all this time they've built a very good record investing in large value international and global stocks. Since they started Causeway in 01, they've built up a team. It's now 35 analysts. And really all they do is this value strategy, and so they're all steeped in that strategy, so you really have a team and managers doing the same thing, all on the same page. I would note the recent performance has been lousy, in part because they've been disciplined, I think because they've really stayed true to that value's
been out of
framework,
style.
and so they don't look very good when you think about it from that perspective. But obviously, as our ratings imply, we think that when the cycle turns, they'll look a lot better.
Okay. Fidelity Growth Company, not a value fund, it's a high growth fund, also rates highly from the standpoint of people, long-term manager certainly, but what else factored into that high people grade for this fund?
That's right. Fidelity has a great analyst support team, well over 100 analysts globally. But obviously, if you look at our people ratings for Fidelity funds, you'll see there are some we're rating average, some above average, and some high. So obviously, Steve Weimer is the difference here. Just an outstanding growth investor, someone willing to invest in companies before they go public, but very much someone who is, as the growth world has evolved, he's continued to evolve, and so that as the Googles and Apples dominate, he's done a great job of rolling with that and really making the most of the FANGs as well as the smaller companies out there, but just really an outstanding investor. That track record is absolutely remarkable. I'm kind of surprised he doesn't get more attention given how good that record is.
Mm-hmm. Let's talk about T. Rowe Price tax-free high yield. There were a few T. Rowe funds that, or maybe more than a few T. Rowe funds that earn a high people grade, but let's talk about this one. You and the team like T. Rowe's Muni team quite a bit.
That's right. Bond funds tend to be team managed, and generally we rate all of the team's funds, they're going to have the same people score. Process, it's possible it'll change, but it's very rare you'd see a different people score at a different fund if it's exact same people. And so at T. Rowe, of course, you've got that diversified, plain vanilla kind of approach with an emphasis on issue selection. And so over time, we've warmed up to T. Rowe's muni funds. If you watch the ratings over the years, we've gradually raised their ratings. And so that's why you see the T. Rowe ratings at high, nice, stable, experienced team, doing exactly what you'd expect them to do. Nothing very exciting, but again, who wants excitement from a muni fund?
Right, but this is kind of an aggressive one, right? So
the high yield one is, yes. So it's one that's willing to take on a fair amount of credit risk. So the high yield team, the high yield fund is definitely on the more aggressive. I was speaking a little more towards their efforts in more generally, but you're right. The high yield fund is more aggressive, takes on greater credit risk. So in a downturn, you'd certainly expect it to lose more than your garden variety muni fund.
Okay, Russ, it's always great to get your perspective. Thank you so much for being here.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.com.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Julie Buzil-Sharma explains why we raised Intuit's fair value estimate.
We are raising our fair value estimate for wide moat Intuit to $277 per share from $199 per share, leaving the stock fairly valued. We've raised our fair value estimate for Intuit after considering a lower cost of equity and the company's potential for further operating leverage, as we expect the company to continue to benefit from its transition to a subscription model. We think Intuit will be able to yield a near 10% 5-year compounded annual growth rate in revenues over the next 5 years and expand operating margin by 10 points with help from both the accounting and the tax business. In taxes, we think Intuit will be able to benefit from attracting new users due to more tax simplicity, which tends to make taxpayers more comfortable with using do-it-yourself software as opposed to going with assisted tax services, which make up about 60% of all U.S. tax filings. In accounting, QuickBooks has had decent success in adding new subscribers from the self-employed market due to the rise of the gig economy, and we think it will continue to add subscribers off of this base. With scale off of this growing base and more efficient marketing spend via connecting once discrete Intuit offerings like Mint and TurboTax, improving operating leverage is realistic in our view. But all of that being said, we think Intuit's business isn't immune from risk, which leaves the company with a high uncertainty rating. The IRS has the ability to create its own tax filing software. However, we believe this is highly unlikely given the IRS's resources. Still, we've modeled this worst-case scenario, which we think has less than 5% probability of occurring, and this still leaves returns on invested capital well above the weighted average cost of capital over the next 20 years, which makes us even more confident in our wide moat.
Now Katie Reichart examines Oakmark's success.
The Oakmark funds, advised by Harris Associates, have a successful history dating back to 1991. The team is proven. CIOs Bill Nygren for U.S. equity and David Harrow for international equity have successful records spanning decades. Their eventual retirements down the line will be a loss, but the firm has named co-managers on their strategies, which is encouraging. Although the firm's analyst bench has had turnover through the years, the team overall is experienced. The analysts, who are generalists rather than being boxed in by certain sector-level focuses, have free rein to dive deeply into company-level research, Oakmark's forte. The firm started an associate analyst program in recent years to spot promising candidates early on and grow talent internally, rather than just hire experienced analysts from elsewhere, which should continue to strengthen the team's depth. The Oakmark funds succeed with a patient, focused, and flexible value approach. The team aims to buy companies trading at a discount to their estimated estimated intrinsic values with a level of analysis that goes well beyond traditional price multiples. Management teams with an owner mentality are a must. To ensure stringent vetting of ideas, there are 2 investment committees comprised of senior team members, one for U.S. equities and one for international equities. These committees must agree to add stocks to an approved list, from which managers then draw ideas. Regular team-level devil's advocate debates help challenge portfolio holdings and ensure rigorous analysis. The Oakmark strategies are no benchmark huggers. Stock picking drives their success. The portfolios are focused, ranging from 20 to 65 names. That helps picks stand out, though it also means the strategy's performance patterns aren't always predictable. Oakmark funds include 7 strategies: U.S. equity, international, global, international small cap, and equity income. There are also 2 select funds that are more concentrated versions of the U.S. equity and global strategies, and those tend to be more volatile than their more diversified counterparts. Over time, the strategies have thrived through strong performance, though by nature, returns can be boom or bust for periods, so investors should have a long time horizon. Oakmark has closed some strategies in the past as assets have risen, which works in investors' favor, though fees are middle of the road.
Expand your investing horizons and look to the long term with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. And lastly, Damian Conover discusses pharma earnings.
The majority of the large-cap pharmaceutical stocks have reported 2019 results, and the results are largely as we anticipated. However, I think there's a few really important takeaways from this recent earnings season. First off, drugs that are innovative, targeting areas of unmet medical need, are really driving growth. This is different than a decade ago when the pharmaceutical firms were really targeting drugs that had sort of Me Too indications, slight improvements. That's different. With a lot of new pipeline drugs coming out of the early stages of development and into the market, we're really starting to see a lot of growth in drugs that target areas like oncology and immunology. So growth is really starting to improve. The second point is these drugs that are driving the growth tend to have very strong pricing power and don't need a lot of marketing support because they're targeting more niche indications. So what that means is improving margins. So these strong margins not only support the results, but also reinforce our view that this industry has a lot of wide moat companies within it. The third point is from a valuation perspective, while we don't see as much opportunity as we once did about a year ago, we still see a few stocks that look undervalued. One of the names we like right now is Merck. Merck is very well positioned in immuno-oncology. Their key drug, Keytruda, looks well positioned for a lot of growth, and we think it's underappreciated by the market. We also think this drug is really emblematic of some of the themes we're talking about. It is a specialty drug with strong pricing power that should drive improving margins for Merck going forward. So overall, we've seen a good earnings season from the large cap pharmaceutical stocks, and we do see some opportunity for investment, especially in Merck.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.